Hi everyone, hope all of you are doing great, and I welcome all of you to this new video brought to you by International Tax Academy. The video pertains to the discussion on subject to tax rule STTR, and this video is being brought to you by Manoj Naudiyal, LLM International Tax. I am Manoj Naudiyal. Fine. So let me give you a quick background of this STTR, subject to tax rule, right? Yes. Okay. Subject to tax rule STTR. Last month 17th and 18th of July 2023, G20 had its meeting in India. This meeting was of G20 finance ministers and was also attended by G20 central bank governors. In this meeting on these 2 days, OECD BEPS inclusive framework presented certain documents, number of documents pertaining to Pillar 1 and Pillar 2 to the G20 group of finance ministers. Pillar 2, there were 3 documents. First document was agreed administrative guidance on globe rules, Second document was globe information return, and the third document was STTR, subject to tax rule, the provision and the commentary. The provision plus the commentary, right? So now you would understand that the subject of this video is the third document, STTR, that is provision plus commentary. There was one document which was released under the heading of Pillar 1, and that document pertained to Amount B, that deals with application, simplification and streamlining of application of arm's length principle to baseline marketing and distribution activities. That will be the subject matter of some other video. Fine. So these 4 documents were released by OECD on 17th and 18th of July in the G20 meet that was held in India. Fine. And the subject matter of this video is STTR, that is provision plus commentary. Okay. This document STTR that contains provision and commentary, I'll just show that document to you. This is the document. Yes. Okay, yeah, so this is the document STTR Pillar 2, subject to tax rule, right? Okay. So this video is actually going to be divided into 2 parts. In the first part, it's a brief video, I don't expect it to be a very long video, but nonetheless this video is going to be in 2 parts. In the first part, I'll give you a gist of STTR, what is STTR, the background, operation, etc., the gist of STTR, and in the second part I'll take you through the structure of this document. That is structure of this document that contains the provision and the commentary, the structure of the rule as such. Fine. Okay. So and yes, before we begin the first part of this video, that is the gist of STTR, a quick update. International Tax Academy is commencing. It is starting the ADIT December 2023 preparatory batches for Principles of International Taxation module, PIT module, and Transpricing module. The batches are starting this Saturday, that is 19th of August That will be immediately after the declaration of June ADIT results, and the batch would be the weekend batch. Classes will be held on Saturdays and Sundays, so the working professionals can attend the batches. Enrollments are open, so you are most welcome to join. For any inquiry, you can send me a WhatsApp on this number, +91 88 51 66 3073. Fine. So that is +91 88 51 66 3073. This is the phone number, right? So now, without further ado, let us start the first part of this video, that is the gist of STTR. STTR, the gist. Subject to tax rule, STTR is an integral part. STTR is an integral part of the consensus solution. STTR is an integral part of the consensus solution on Pillar 2. This consensus solution was reached by the BEPS inclusive framework, BEPS if, on 8th of October 2021. If you look at that statement, the statement, 8 pages statement, it mentions that STTR is an integral part of this consensus solution, right? Consensus solution on Pillar 2. Pillar 2, what is Pillar 2? Pillar 2 consists of rules that provide certain jurisdictions with taxing rights, wherein other jurisdictions have not exercised their primary taxing rights, or otherwise the payments are taxed at a rate which is below the minimum rate, that is below 15%. Fine. So in that case, Pillar 2 rules provide certain jurisdictions the rights to tax back those payments. Fine. So that a certain minimum level of taxation is achieved. Now, Pillar 2 consists of certain rules. Pillar 2 consists of globe rules, income inclusion rule, and under tax profit rule, UTPR mainly. Pillar 2 consists of globe rules, and these globe rules are designed to ensure that large multinational enterprise groups pay a minimum level of taxation on the income arising in every jurisdiction, in every country where they operate. These rules are designed to ensure that the large multinational enterprise groups pay a minimum level of taxation, that is 15%, in every jurisdiction in which they operate. Fine. So Pillar 2 consists of globe rules. Pillar 2, in addition to the globe rules, it also consists of STTR. STTR is a treaty-based rule. Tax treaty, normal double tax convention, tax treaty. So STTR is a tax treaty-based rule. It's a tax treaty or treaty-based rule. Tax treaty-based rule, right? It's a tax treaty-based rule. Tax treaty-based rule, and it would be applied on certain intra-group outbound payments. Residence country, source countries. STTR is a tax treaty. Tax treaty exists between R and S. STTR is a tax treaty based rule that would be applicable on certain payments, outbound payments which occur between the M&E group companies, wherein these outbound payments are taxed below the STTR minimum rate, and that STTR minimum rate is 9%. I'll give you the mechanics, don't worry. Fine. At this point in time, I'm simply explaining to you that Pillar 2 consists of globe rules as well as the STTR. STTR is a tax treaty based rule. So now we have reached STTR. Let us move further. Okay. RS tax treaty exists between them. Income, right? R and S, they have a tax treaty between them. And now we are looking at STTR, which is a tax treaty based rule. So STTR, or subject to tax rule, I'll tell you what it is not. It is not designed, it is not expected to revise the allocation of the taxing rights. STTR is not expected to revise the allocation of taxing rights between R and S. Instead, or rather, it is expected that where the taxing rights of source country, where the taxing rights of source country are limited under the tax treaty, where the source country has surrendered its taxing rights on certain payments under this RS tax treaty, where the S country's taxing rights on this income is limited, and number two, where this income is taxed in our country at a rate which is less than 9%, which is less than 9%. If these two conditions are satisfied, then S country will regain some of the taxing rights that it had originally surrendered. This is the scheme of STTR. Fine. So STTR is a tax treaty based rule. Fine. Should be very, very clear about this. Now, second point, on what income this STTR would be applicable. STTR would be applicable on interest income. So this income is interest income. This income would be royalty income and a defined set of other payments. Interest income, royalty income, and a defined set of other payments. These payments have to be between the group companies, between the M&E group companies. So this is intra-group. These are intra-group payments. Intra-group payments or payment between connected companies, connected persons, connected companies. Right? So this is the basic scheme of STTR. Right? Okay. Obviously, when the income is reaching our country, it would be subject to a certain tax rate in R, and that tax rate is less than R, is less than 9%. Only then STTR will come into play. But whatever taxing right is applicable on this income in our country, that taxing right would be taken into account while the S taxing right is being calculated. So STTR basically allows for an additional tax. It allows for STTR allows for an additional tax to be imposed by S. That is the tax which has already been paid upon this income in our country, that will be taken into account while you are calculating the additional tax, that is the tax payable under STTR in S country. Right, fine. Okay, what else can be given in the gist? Yes, the STTR document that was released, that contains certain provisions which are expected to take care of certain structures created by M&Es which create high BEPS risk, base erosion and profit risk, for S countries. So it has a targeted anti-avoidance rule. Fine. Okay. And yes, how this STTR would come into picture, would come into play. See, there is a commitment. There is a commitment. If you look at these two countries, R and S. R country, the residence countries. S country is the source country where the income arises. R country, in most of the cases, they are developed countries. S country is a developing country. So under STTR, R country, developed country, treaty partner, they have given a commitment that whenever S country, their treaty partner, which is a developing country, whenever S country would make a request to them that we want to include STTR into our bilateral tax treaty and the conditions are satisfied. In such case, our country will agree to such a request, and this STTR provision will be incorporated into their bilateral tax treaty. Fine. So quickly recap. Treaty based rule, two conditions have to be satisfied. As countries have ceded their taxing rights under the tax treaty, the income is taxed at a rate less than 9% in our country. If these two conditions are satisfied, then S country will regain the taxing rights under STTR. It's a treaty based rule. It does not reallocate the taxing rights between R and S. Applicable to outbound intra-group payments between S and R. Fine. Additional tax, it's an additional tax. So the tax which is already paid by R, that will be taken into account, that will be considered. Fine. And then the commitment between R and S. Fine. So this is a quick gist. This is a quick gist of what is STTR. Fine. The key point is that this rate 9%. Fine. Now the second part of the video. Okay, second part of the video, I'll give you the structure of STTR. Structure of STTR which is present in this document which I just displayed. The structure of the document.